I think it's another example of the disconnect that has taken place with the COVID lockdown and now the subsequent reopening. It's really a supply-demand imbalance. The demand has been going up because so many companies are reopening, especially in the hospitality and leisure area, but the supply of workers really is slow to catch up. Primarily because you just don't hire anybody off the street. You have to go through a vetting process before these people are allowed to be the representatives of your company. So I think it'll take a little while before this supply-demand imbalance gets back to equilibrium. Well, certainly the Delta variant is causing problems now with, 100,000 new cases on a daily basis being reported. That's obviously not a good thing and is likely to be at least putting some pressure on the reopening communication conversation. So I would tend to say, depending on how bad it actually gets, maybe it could end up putting a little bit of pressure on the economy and the reopenings. But right now, it seems to be more of a hiccup, more of an annoyance than it does a threat that it's going to throw us back into a lockdown. A fairly quiet month in terms of volume. August is traditionally the third worst performing month of the year, but also the third highest in terms of volatility. So I would tend to say, we take 2 steps forward, 1 step backward, and that's going to be the normal trading process this month and next. September is historically the worst month of the year. It's the only month that has posted an average decline and has fallen more frequently than it has risen. So September is a window dressing month. It's an end of quarter month. So mutual funds, investment managers who don't want to admit to their clients that they own a stock that's been doing quite poorly will look to unload those issues in September. So I would tend to say that investors need to fasten their safety belts. It could be a bumpy ride, but don't use it as a reason to bail out of stocks. I think that the market certainly has an upward bias at this point in terms of earnings growth, in terms of economic expansion, et cetera. We don't think that the Fed is going to raise interest rates until late 2022 at the earliest. And so I think investors, even though they've been waiting for this market to digest some of the gains, probably realize that they're better off being in the market than being out of the market. Right now, historically, the defensive sectors tend to hold up the best. By that, I mean utilities, healthcare, consumer staples, but also technology tends to do relatively well in August. So with earnings growth expected to be up more than 85% in the second quarter, and now likely to be up about 25% in the third quarter, still there's that upward bias. So I would tend to say don't go too far out on the risk curve by having too much stock, but the same goes for having too little stock. In terms of the technology area, our feeling is that we have a buy recommendation on many of the stocks in the semiconductor equipment space, because if we do have the shortfall in terms of supply for semiconductors, then obviously those companies that make the semiconductors are likely to do very well. Application software, we're also fairly favorable with, the biggest component there being Microsoft. Other areas, system software also is a favored group. So with companies like Oracle, like Microsoft, as well as other application and system software companies expected to do well, then that's where we have most of our buy recommendations at this point.